Right now, Opendoor Technologies, ticker OPEN, is trading at $7.57 per share, down a sharp 57 cents, a drop of 7.00% just today. And while many might see that steep decline and immediately think it's just broad market weakness or a knee-jerk reaction to some headline, the reality is far more specific and deeply rooted in the company's core business model. This isn't just a bad day for a tech stock. This is the market expressing a very real and growing skepticism about the fundamental viability of the iBuying concept in the current economic climate. The very premise of using algorithms and massive amounts of capital to flip houses is being stress-tested in real time, and today's price action shows the foundation is shaking. The general belief, the story that has been sold to investors for years, is that Opendoor is a technology company first and a real estate company second. The expectation was that its data science would create an insurmountable moat, allowing it to price homes with surgical precision, turn inventory rapidly, and collect fees, all while offering sellers a level of convenience the traditional market could never match. People looked at the astronomical valuations of names like Tesla stock or Nvidia stock and thought, why can't a tech company that's disrupting a multi-trillion-dollar industry like housing achieve something similar? It was a compelling narrative that drew in a lot of capital and a lot of believers, especially those using accessible platforms like the Robinhood app or SoFi Invest to get into what they thought was the ground floor of a major industry shift. But that expectation is colliding with a very different reality. The 7% drop we're seeing today isn't an anomaly. It's a reflection of the fact that Opendoor is not a pure tech company. It's a capital-intensive, low-margin, highly cyclical business that carries immense balance sheet risk. Unlike Apple stock, which sells high-margin products globally, Opendoor buys and holds a physical, illiquid, and geographically concentrated asset, single-family homes. Every tick up in mortgage rates, every sign of softening home prices, every extension of the time it takes to sell a home directly attacks their bottom line. The algorithms can only do so much when the macroeconomic environment turns hostile. What we are witnessing is the market recalibrating its understanding of the company, shifting it from the disruptive tech category to the highly leveraged real estate category. And the valuation adjustment is, as you can see, quite painful. Let's break down the recent movement. Today's sell-off is happening on significant volume, suggesting that this isn't just retail investors getting scared. This has the fingerprints of institutional players re-evaluating their positions. When you see a stock with this kind of volatility, serious traders on platforms like Interactive Brokers are watching the order flow and the Level 2 data very closely. They're seeing large blocks being sold, indicating that some of the bigger funds are reducing their exposure. This isn't about a single bad earnings report. This is about the forward-looking picture. The Federal Reserve has been clear about keeping rates higher for longer to combat inflation. For Opendoor, that's a direct and severe headwind. Higher mortgage rates crush housing affordability, which in turn reduces buyer demand. This means Opendoor's existing inventory of homes sits on its books for longer, racking up financing, maintenance, and tax costs. It also means they are forced to sell into a weaker market, compressing or even eliminating their potential profit on each transaction. Think about their business model. Opendoor makes a cash offer on a seller's home. If accepted, Opendoor buys the property, performs some light repairs, and then lists it on the open market. Their profit is intended to come from the service fee they charge the seller and any appreciation they can capture between their purchase price and their eventual sale price. In a hot, appreciating market with low interest rates, this model works beautifully. Homes sell quickly, often for more than the list price. But we are not in that market anymore. We are in a market where home sales are slowing and prices in many regions are flat or declining. For Opendoor, this means every home they buy is a potential liability. If they misprice a home on the way in and the market softens even slightly, they can be forced to sell it at a substantial loss. This is the core risk, and it is what the market is pricing in with today's 7% decline. Investors are looking at the company's massive inventory and seeing not assets but potential write-downs. Many investors who are new to self-investing might look at this drop and think it's a buying opportunity. They might log into their Fidelity investments or Charles Schwab account and see a stock that's far off its highs, thinking it's cheap. But cheap is relative. The more critical question is whether the business can sustainably generate profits through a full real estate cycle. Past performance is telling. During the housing boom of 2020 and 2021, Opendoor's revenue soared, and the market rewarded them with a sky-high valuation. But as soon as the Fed began its tightening cycle in 2022, the model fractured. The company was forced to sell thousands of homes at a loss and take massive inventory write-downs. They have since adjusted their strategy, becoming more conservative with their purchasing and focusing more on contribution margin per home. However, the fundamental sensitivity to interest rates remains. This is not a company that controls its own destiny in the same way a software or semiconductor company might. Its fate is inextricably linked to the decisions made by the Federal Reserve and the subsequent behavior of the U.S. housing market. For those looking for investment help or considering automated options like Schwab Intelligent Portfolios, a stock like Opendoor highlights the importance of understanding industry-specific risks. A robo-advisor might allocate a small portion of a portfolio to a stock like this as part of a broader diversification strategy. But a concentrated individual bet requires a much deeper understanding of the forces at play. You need to be watching housing inventory data from the National Association of Realtors, tracking the 30-year fixed mortgage rate daily, and listening intently to every word from the Fed. It's a full-time job, which is why platforms that offer deep analytics like Interactive Brokers are so valuable for those taking an active approach. So, where does Opendoor go from here? The future outlook is a tale of two very different scenarios. The bullish case hinges almost entirely on a significant pivot in the macroeconomic landscape. If inflation comes down faster than expected and the Fed signals a series of rate cuts, mortgage rates would fall, and the housing market would likely see a resurgence in activity. In that world, Opendoor's business model becomes viable again. They could ramp up acquisitions, turn inventory faster, and return to growth. There is also a bull case for their expansion into adjacent services like title, escrow, and mortgage. If they can build a more integrated platform, they could capture more revenue per transaction and become less reliant on the thin margins of home flipping. The bearish scenario, however, is the one that seems to be winning today. This scenario involves interest rates remaining elevated for the foreseeable future, keeping the housing market in a state of low transaction volume and stagnant price growth. In this environment, Opendoor would struggle to grow and may even have to shrink its operations further to preserve cash. The risk of another round of inventory write-downs would be ever present. Competition is also a factor. While Opendoor is the largest iBuyer, other companies are still in the space, and the traditional real estate agent model has proven remarkably resilient. The reality is that for many people, selling a home is the largest financial transaction of their lives, and they still prefer the guidance of a human agent over a purely algorithmic offer. This presents a structural ceiling to Opendoor's potential market share. Before we move on, I want you to comment below. Do you believe the iBuying model as a whole is sustainable through a long-term real estate cycle? Let me know your thoughts. When you manage your portfolio, whether it's through SoFi active investing or a Fidelity brokerage account, you are constantly weighing these competing narratives. For Opendoor, the expectation was a tech-driven, scalable platform that would generate software-like margins. The reality is a capital-heavy, cyclical business that is a price taker, not a price maker in its primary market. The company's success is less about the brilliance of its code and more about the direction of interest rates. That is a tough pill for many tech-focused investors to swallow. In conclusion, the 7% drop in Opendoor's stock price today is not random market noise. It is a clear and direct referendum on the iBuying business model in a high-interest rate world. The market is signaling its belief that the path forward is fraught with risk and that the company's fate is largely outside of its own control. The optimistic narrative of tech disruption has been thoroughly challenged by the harsh reality of real estate economics. The expectation was that data would conquer market cycles. The reality is, market cycles, particularly those driven by central bank policy, remain the dominant force. For any investor looking at Opendoor, the key takeaway is to see the company not for what its proponents hope it will be, but for what its balance sheet and the macroeconomic data clearly show it is. Right now,